Most limited company owners plan for around 19% corporation tax. That figure is real, but it only applies to some companies, and here's how to know if it applies to yours. According to gov.uk, UK corporation tax currently has 3 distinct bands. Profits up to £50,000 pay the small profits rate of 19%. Profits above £250,000 pay the main rate of 25%. And profits between those two thresholds sit in a middle band where neither headline rate applies cleanly. And that middle band is where most growing limited companies land, and it's exactly where a flat rate assumption causes the most damage. Get the band wrong and you could underprovide for your tax bill by thousands. But the middle band works in a way that can surprise most owners. In the middle band, between £50,000 and £250,000 profits, HMRC applies something called marginal relief. It's not a fixed rate. It's a formula that gradually reduces the relief available as your profit rises. It produces an effective tax rate that slides between 19% and 25%. Think of it as a ramp, not a step. A company with £150,000 profit does not pay 19% and does not pay 25%. It pays something in between. And that number requires an actual calculation and not some rate table. The practical implication here is straightforward. If you are in this band and you are setting aside reserves or planning drawings based on either headline rate, then your provision may well be wrong. You can use HMRC's marginal relief calculator to get the actual figure for your profit level. One more thing here, marginal relief does not apply above £250,000. Cross that threshold and all your profits are taxed at 25% with no tapering. But the rate itself is not the only variable you need to check. There are 2 practical risks that catch owners out before they even reach the calculation stage. First, associated companies. HMRC defines an associated company as one where a common person or group controls both businesses. If you have associated companies, the £50,000 and £250,000 thresholds are divided between them. If you run 2 associated companies and your small profits rate threshold effectively halves. That can push you into the middle band or even the main rate band without your profit changing at all. And second, corporation tax is unfortunately not the only tax in play. The company pays corporation tax on profits, but you as a director also pay income tax and national insurance on any salary drawn through PAYE, and dividend tax on any dividends taken. The most tax-efficient combination of salary and dividends depends on your personal income, your profit level, and of course which corporation tax band you're in. These taxes all interact. Planning one without the other gives you an incomplete picture. So, what's the practical rule to take away from this? Well, identify your profit band first, then calculate from there. Under 50,000, 19% straightforward. Over 250,000, 25% no relief, straightforward. But between the two, use the marginal relief calculator on gov.uk. Don't make a flat assumption. But before you do any of that, confirm whether you have any associated companies, because that changes all of your thresholds. And of course, factor in how you draw income, because corporation tax is only one part of your total tax position. The band determines the method, and get the band right before you plan anything else. If that was of value, subscribe to the channel for one real business question answered every video. For the same clarity in writing, the website and newsletter is 5minutebusiness.com.